Hey, it's Rob. Welcome to Everyday Investor, the hottest investment show in the world. That's right, I said it. I don't care who knows it. This entire show, the whole 17 years we've been doing this, and that's right. We're here in 2021. Started this in 2005. I think that's my 17th season. I'll be embarrassed if it's not. This whole show is designed to help us grow our money. You see, the challenge is we spend a lot of time, maybe more time than we want, going to work to get money in order to provide. We go to work, we take our time, we go to work, we get a paycheck in order that we can eat. Nothing wrong with that. I believe we were created to work. But imagine a world where money could make you money. You could work a little less and have more time for the things that matter most: family, friends, a purpose greater than yourself. Remember, when anyone offers you any type of investment opportunity, the first question you always want to ask is, what is the projected return on investment? Number 2, when do I get that return? 3, what is the minimum investment amount needed? And 4, what is the risk, the worst case scenario? Today, we are going to be talking to, wait for it, we'll be right back. Coming up, Andrew Hines teaches us how we can grow our money with the R5 strategy.
Well, the most basic way to look at it is going back to the bank to get them to give you, say, 80% of what your property is actually worth.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey, it's Rav. Welcome back to Everyday Investor. Super excited for my good friend, real estate coach, real estate trainer, real estate investor, Andrew Hines is on the show, and he's going to be teaching us how we can make money investing in the R5 strategy. Before we talk to Andrew, let's go to our market expert, Omar Khan. Omar, what's happening in the world of stocks this week?
Thanks, Rav. Omar Khan here, guys, with Data Trading. Just want to give you guys a market update, weekly market update. We're approaching all-time highs. In fact, we are at all-time highs, almost on the NASDAQ, on the S&P 500, and the TSX. So the market's getting a little bit heated. Now, typically the second half of February isn't the best time for the market, so you could see a little bit of a pullback. Who knows what will happen? But we want to keep a track of is valuations, right? Corporate earnings are coming really good, meaning companies are making a lot of money. But with the stock market, you have to consider how much am I paying for this company? Right? And now a lot of stocks are getting a little bit expensive, right? So you have to consider, what am I paying for this company? I may love this company. I may like it a lot. Am I paying too much for it? And that's the kind of point we're at here with the stock market. You've got to ask yourself that question, because investing is all about return on capital, risk-adjusted return. So the markets are at an all-time high. Let's see how the year plays out. But corporate earnings are coming in really, really well. The economy is improving. Hopefully COVID and lockdown is going to be over soon enough. So that's kind of how we are right now. Let's see where the market ends up, and let's see how it does going forward. Anyways, back to you, Rob, and we'll see you guys here next week.
Thanks, Omar. Always great to learn from you. Look forward to talking to you next week. Andrew, thank you so much for doing the show with me.
Rob, thanks for having me.
Yeah, man, you're a busy guy. You've doing some development projects. You're doing some flips, if you will, or you're going to teach us the strategy in and around the flip world. You've got a podcast that's growing like a weed. What else is happening with Andrew Hines?
Yeah, you just about summed it up. Yeah, I do a little bit of coaching in there, here and there as well. But mainly focused on some of these development projects, doing some construction. Just finishing up some 15 townhouses right now, and working on three model homes for a new 126 unit community.
That's that's a lot of work, but I know you've been at it for a while. So is it stressful, Andrew, or does, as we always say, does education really minimize the risk and bring you confidence? I mean, someone's not going to just jump in and build 50, 100 townhomes or custom homes or kind of what is the process? I mean, where would somebody start if they wanted to be an Andrew Hines?
You know what? That's a good question. So I wasn't like handy with the tools. I had no specific reason to be good at any of that. But I got into doing my own renovations and construction because I wouldn't have been profitable if I had hired others. And what I mean by that is not so much that I was doing the work, but I was hiring. I was hiring the individual trades, and I was kind of working alongside them to learn so that I could properly delegate tasks. And I think that there's a huge benefit to being grassroots about your growth, and you start kind of at the bottom. And I know there are corporations that want their employees to work in every lower end job before they work up into management. And it's a similar concept with real estate investing, or if you're flipping, or if you're doing the R5 strategy or the BRRRR strategy that, depending on what people refer to it as, that you have a basis of understanding of what goes into it. You want to know what goes into it so that you can properly delegate tasks, and you'll know if somebody's trying to pull the wool over your eyes, or maybe not being completely forthcoming with you, kind of that BS detector, so to speak.
Yeah. And I think that, that's for somebody that wants to be active in the game, which I know you enjoy doing this, and it's your full-time gig. And then there's others, such as yours truly now, that just wants to be passive. And, that's where Rav could, lend Andrew money, or, put money into the project, and we can split, 50-50, doing an equity deal. Yeah, I would agree with you. I mean, if you're going to start a business, you should probably, and you're in the business of investing, you should probably know all the ins and outs of all the different aspects. So then when you do hire people, you know exactly what you're hiring them for.
Yeah, like I can't tape drywall, but I've been present, watched closely, kind of seen it. And I know what, fast looks like. I know what slow looks like, and I know what it should cost. And when I was getting started, I used to break things down really simply. If I knew a job was going to take somebody 40 hours and I figured they're a professional, they're going to want 50 an hour or something, I'd work backwards. And if they gave me a price that didn't make sense, then I could call them out on it and say, hey, you know what? That doesn't make sense. That number seems a little high. Even though I had no basis, I had no understanding. It was just really coming down to being curious. But yeah, you're right. That's more on the active side. If you want to go on the passive side, there are certainly ways to go about it where you can be less and less involved.
And so, Andrew, on today's episode, I mean, I know you can teach us different strategies, but the one that you kind of go to all the time, I call it the R5, others call it the BRRRR. Talk me through that a little bit, and then we can dissect some numbers when we come back from the break. So what is it exactly?
Well, the idea is that, I mean, for myself as an investor, I want to be able to pull as much of my money back out of a property that I buy. So the idea is I'll buy a property that needs some work and hopefully get it for a little bit of a discount because of the work it needs. And knowing the value that I can add to it, I can say, hey, if I buy this property for say 200,000 and I put in 100,000, I'm in for 300, but maybe that property is now worth 400. And say that property was worth 400, now I can borrow against the 400, despite the fact that I'm only into it for 300. And we can get into some specific numbers of a deal that I've done after the break, of course.
So number one, we require a property, and what I heard you just say is it's very important. Can I use this word, undervalued? Would that be the right word, Andrew?
Undervalued. Well, you have to look at it. You have to have an ability to add value. Now, whether that, sometimes your value add in a situation is you find a property that, the seller's in a unique situation and you can buy it undervalued, as you've said. But there's other times where you can buy it at market value, but maybe me as an expert in my specific type of real estate, I know that I can do something that others won't necessarily know how to do, and I can add value that way. So I can afford to buy it at market price potentially, as long as I understand my value add strategy, how I'm going to make it worth more. Very
smart. So market value is $400,000, and you have the ability to buy it at 350 or 360 or whatever the case is, or you buy it at market value, but you see the potential maybe to put in a basement suite in there, or maybe to add something else, make it into a semi.
We'll add an addition. So that's the example we'll do. So we won't do the numbers yet, but conceptually, so I bought a property, it was only like 650 square feet, and I added a 1,000 square foot addition to the rear. So I took, I bought, relatively cheap, And because I had the trades, because I had worked, this was only about a year and a half, 2 years into my renovation, value add strategy. Because I knew the right people, I knew I could do it. So other people wouldn't have jumped at that, but I knew I could. So I went ahead, I paid the price for it, put the renovations in. And when I was all done, there was a good chunk of what we would call sweat equity, money that was created, value that was created in that property.
Because you, again, added value through renovation to put in an addition, put a basement apartment, do whatever you do. Okay, so we acquire a property, we renovate it. What's the third R? Then what?
We're going through your model here. So renovate, rent would be the next one.
I mean, this is the same as your model. I mean, you would say buy a property, and then you would say
acquire. Yeah, you're right. Okay, so rent's our next one. I always have to say it to myself out loud, kind of like saying my ABCs.
So now you rent the property out, and obviously you're getting a premium rent than what market value rent is because you added value through renovation, correct?
Mm-hmm. Yeah, so for instance, I do student rentals. More bedrooms is more rental income. So if I'm able to add 3 bedrooms by adding an addition, now I might have added, say, almost $2,000 in extra rent.
So let's park there for a second. Is all your product, Andrew, stuff that you would want to live in, or not necessarily?
Yeah, that's generally been my mentality. I want to know that I renovated it in a way that I would be willing to live in that myself. And, I kind of apply my own standard, from a student rental investor standpoint. I know what I went to school in. I know I didn't like living in it. I know what I would have wanted to live in. And that's what I aim to create.
Okay, so here's where the magic happens. We acquire property to do this. You renovate it, you rent it out, and then you refinance it. So Andrew, I'm a man of simplicity, not because I think it's smart, but I have no other choice. A very simple person. Can you simplify this? What does it mean to refinance? I'm surprised that people don't know that they can pull money out of their homes, out of their investments, but I never really know how to explain it to them. Can you try to explain what does it mean to refinance?
Well, the most basic way to look at it is going back to the bank to get them to give you, say, 80% of what your property is actually worth. So rather than, the bank doesn't care what you paid for it. They don't care how much you've renovated it, really. I mean, the appraiser might care, but what they really are going to do is they're going to send out the appraiser. The appraiser is going to compare other properties in your area and say, hey, your house is worth 500 grand. So even if you paid 200 for it and you had like a $100,000 mortgage, they don't care about that. They say, okay, 500 grand, you can borrow 80% of that. What's that work out to be? 420,000. So you can borrow 420,000. So if you only had a $100,000 mortgage, but the bank says you're approved for 420, well, now you're going to get an extra $320,000 approximately deposited into your account when you refinance. So they'll pay out the old mortgage and they'll give you the balance, the difference of that money.
The reason why I get to pull that out is because back to step number 2, I renovated this property. It's now increased the value. So if I originally bought it for 400, it's not worth 400 anymore. It's now worth 500. So the bank allows me to take out more money because I've increased the value, correct?
Absolutely, yeah.
Okay, and then that's where Andrew keeps this property and then takes what he pulls out and does another one.
Yeah, and that's the whole point, right? So the average Canadian, right? Like we have our savings, maybe we can buy one property. It takes a long time to save up money to buy a property. So if this is part of your retirement strategy, it makes a lot of sense to go back and try and pull out as much of your money as possible. And if you can pull out all your money, then you're hypothetically in a situation where you can grow as fast as you want. As long as you can keep finding deals that work, you could maybe add 15, 20 properties to your portfolio in a couple of years.
And your way of doing it is you really don't want to be out of pocket. When you're repeating this, the 5th R, when you're repeating it, you're pulling out as much money as possible so long as those rents cover all the expenses so that you have a little bit of cash flow or at least break even, correct?
Yeah, absolutely. And the bank is going to require that. They're not going to give you the 80% that we talked about if your cash flow doesn't look good. They're going to need to see good, strong rents relative to your mortgages. So you're going to want to make sure, like anyone like watching this, they're going to want to make sure that you do a hypothetical with your mortgage broker and make sure that your end product is going to be sufficient to get the money back out.
Beautiful. Okay, folks, this is what we call the R5 strategy, commonly known as the BRRRR I like to see things cheesy, such as Cobra Kai, finished all 3 seasons. But when it comes to an investment strategy, Burr is a little bit too cheesy for me. Yes, Mr. Cheese himself. So we are calling it the R5 strategy. You require a property, even though it's really acquiring a property, but I couldn't find the first word that started with R. So we require a property, we renovate it to add value, we rent it out. Now the bank sees that you have cash coming in, so they'll give you more money because the value is higher. So therefore we pull it out, called refinancing, and then we just repeat this. And this is one of the strategies that Andrew Hines does all day long. Let's look at one specific deal with Andrew. When we come back, don't go anywhere. Everyday Investor continues in a moment. Hey, it's Rav from Everyday Investor TV show. Super excited. After 17 years of being on TV teaching investing, we finally are having our very first workshop. It's the Everyday Investor Workshop, March 6th. It's a Saturday, 10 a.m. to 4 p.m. My good buddy Ray Ostrander will be doing some teaching along with me. You don't want to miss it. Make sure you register at everydayinvestor.com. Hey, it's Rav. Welcome back to Everyday Investor. We're talking to my good friend Andrew Hines, a real estate investor, trainer, coach, and he is teaching us the R5 strategy. Before we dissect one of his deals, let's go to our mortgage expert, Kyle Ford. Kyle, what's happening this week?
Thanks, Rav. Today I want to talk about self-employed mortgage financing. Many clients come to me and say, Kyle, I'm self-employed, I can't get a mortgage. Though self-employed clients do face different challenges than an employed client, it's absolutely possible to get a mortgage while being self-employed. First thing we want to talk about is showing your income. As a self-employed client, people tend to want to write their income down to very low. Unfortunately, a lender sees that as not being able to service the debt. So it's important to find that balance when it comes to qualifying. The next part is B lenders. If you've been self-employed for less than 2 years, you might need to use a B lender. They're going to qualify based off bank statements and revenue as opposed to claimed income average. When it comes to being self-employed, make sure you're working with a mortgage professional who understands all the different markets. Thanks, and back to you, Rav.
Thanks so much, Kyle. Always great to hear from you. We'll tune in to you next week. Andrew, thanks for being on the show with me, my friend.
Rob, thanks again for having me.
Yes, tell me a little bit about your backdrop there. I want people to be able to follow you there. That's the Andrew Hines show.
Yeah, the Andrew Hines Real Estate Investing Podcast. Anyone wants to find me, it's on all podcast platforms. You just search my name, Andrew Hines, and you'll find it, including YouTube.
Okay, so we've been talking about this R5 method. Break down a deal for me.
Yeah, so I the one I was telling you about briefly before the break there. So I bought this house. It was like 600 square feet. Wasn't big enough to be a student rental, but I wanted it to be a student rental. So I built 1,000 square foot addition. Now I purchased the property, and I'm going to round these numbers just to make it easy.
Yep.
So I purchased the property for $245,000.
Okay, so 245K. Yeah.
Yeah, and then call it about $205,000 for all of my renovations and my carrying costs, my closing costs, all that stuff to do that addition.
So 205K, we'll call that the investment amount?
Yeah, or the improvements. Yeah, however you like to look at that.
Yeah.
So after all that was said and done, I was into about $450,000 into the property. So to total those two up. And now, so from a financing standpoint, do you want me to go ahead and walk you through how that looked?
Sure.
Yeah. So I basically got an appraised value of $540,000 on that.
540, the bank told you it was worth right away.
Yeah. I went right back as soon as I was done. I put the tenants in it. So I did the rent portion and I put the tenants in it. And then I went right ahead and initiated that refinance.
Okay.
And right off the bat, they said it's worth $540,000.
Okay. So this is
immediate equity in that property.
So that's the new value.
That's the new value. Yeah. So you can see there are approximately $90,000 of money just created.
Yeah.
Okay, so I get 80%. The bank was okay with 80% in that scenario, so they were willing to lend me 432,000.
432,000 you could take out.
Yes, right.
Okay. So bank gave you 80% of that, which was
432,000.
okay.
And so if you subtract that, so you take the 450,000 that I'm in for,
Yeah.
minus the 432,000, we come up with 18,000, which was my net investment there. So I was able to pull everything back out except for that 18,000.
Okay, so I want to be clear here. You bought a property for $245,000. Your investment amount, your renovation amount, all the costs, so on and so forth, was $205,000. So you're in for $450,000. Once we were done and you put the tenants in, the bank looked at this product and they appraised it at $540,000. To do a proper refinance, you are able to take up, you got to leave 20% in. The bank wants to see you, for those of you that are watching and listening, the bank wants to see you have some skin in the game. They want to see you have, as an investor, 20%. So you're allowed to take out 80. So what Andrew did was he took out 80%. So he took out 322,000. He was in for 450. Now he's only in for $18,000. So Andrew Hines has a $540,000 property that's cash flowing, and he's only in for it for $18,000. You take this other 432 and you do it again. Yeah?
Yeah, that's the idea. Do it again. And ideally be able to maybe even be able to have no money in if you do it really, really well. Maybe you can even get paid to keep the property. And I've had that happen as well.
And the part where I think is tricky and you have to really know what you're doing is to be able to spend that 205 to make sure that the value is going to come out to be 540. Because Andrew, I think it's good to park there for a second, and I know you're very knowledgeable. When it comes to step number 2 in the R5 strategy, renovating, rehabbing, what are the things that you look for? So in this case, was this the one where you made an addition and added a few more bedrooms?
Yeah, I added the addition. So I'm looking, how can I add income, right? These are rental properties, and anyone who's doing the R5 or BRRRR strategy, you're doing rental properties. So you're always looking for, how can I add income? Because adding income should add value. And specifically in student rentals, that works really well. So I'm going in, do I have space in the backyard? Or do I have space in the existing building? You know, can I create bedrooms here? Would they be desirable bedrooms, right? If it's a basement bedroom and it's a low ceiling, I don't want that. But if it was a really tall basement and I had the ability to make the windows wider, I might really like that. And I'd say that's a really good opportunity to create more bedrooms, create more income, therefore create more value.
Okay, so get us to our ROI. How do we make money on this? Even though, does it really matter? You're in for $18,000 and you know, but yeah, tell me.
Yeah. So the 3 ways I'm making money on this are: one, from monthly cash flows. So after all of my monthly expenses and my monthly mortgage payment, on this property, right at the time that I finished this, I was making just short of $800 a month in cash flow. And
so that's what, 9,600 you have for the year?
Yeah, it worked out to be about 9,500.
Okay.
And then I have annual appreciation. So this is something, this was a few years back, and I just, typically would never really assume more than 3%. That's just my conservative estimate. So that's a passive appreciation, my property going up in value with the market. So I like to assume 3%, even though it's been way more than that in Ontario lately.
3% on the 540?
3% on the 540, which works out to be about 16,200. And then the other way to get return here is your principal pay down. And I actually confused that number before there. The cash flow is actually about 9,300 on the year, if you want to correct that. And then the pay down is actually just around 9,500. So that's my mortgage pay down. So you can basically just sub it into like an online mortgage amortizer, and you can figure out how much you've paid down in a year.
I just reversed them. You're saying the cash flow is 93, the mortgage pay down is 95. Okay.
Yeah. So when you total all those up, let's just total all those up because I hadn't rounded some of those. So just do 9,500 and 9,300. So we're a total return of $35,000 a
So
year.
you're doing 35K, but you're in for you're in for 18K. So if you got your calculator there, what's $35,000 divided by $18,000?
It is 194.44%.
That is ridiculous. That is ridiculous. So you are making $35,000 because it's not all liquid. The cash flow is liquid, but it's increasing. Real estate goes up and down upwards. Someone or a bunch of people, students, are paying down your mortgage. It all adds up to $35,000, but you're only in for $18,000. And this is the strategy that Andrew Hines uses.
Yeah, and if you can do this and find a way to pull out more money, then you have the ability to even just go buy a couple more that maybe don't work perfectly. Like the perfect BRRRR or the perfect R5 is where you can pull all your money out. This isn't quite perfect, but it's getting close. And the closer you can get to that, the more exponential your growth possibilities are.
And what's Andrew's goal? Are we doing one of these a year, one every 2 years, couple a year? Like, what do you try to do with this type of strategy?
With that type of strategy, yeah, ideally, I'd like to be doing a few every year or focus on larger buildings. So now I'm looking for larger buildings to do it on. I was examining one possibility of doing 8 new construction builds all at once that would basically function as a BRRRR where I'd be able to pull out most of the money. And then we'd be into bonkers numbers of cash flow and things like that. So I'm looking to scale. I've done it small, and now I'm kind of at that point where I'm ready to do it much bigger.
Okay, so basically what you're saying is that, you're doing a few of these, you're buying the house, but then you're, kind of adding and putting in more units. So you can do that. And this particular one that we just looked at was what, 5 bedrooms, 6 bedrooms, 4, what was it?
That was a 5-bedroom, yeah.
That was a 5-bedroom. So you can do that. Or what you're saying is now you're trying to get into, apartment building where maybe, it's a 10-plex. And so now you have one roof, one furnace, but the same concept applies, correct? Now it wouldn't be adding
that or houses side by side. That or something like that.
Yeah, I mean, in this case, you wouldn't be necessarily even putting an addition, but you'd be finding something that wasn't managed well or was undervalued. You'd be fixing up these 10 units and then pulling out money and doing the same kind of thing.
Yeah, I'll give you an example. I looked at a building where there had been rainwater leaking in. It was a 4-story building, 8 units, and rainwater had been leaking in down the center of the unit, and it had compromised one of the structural walls. And there was actually a notice from the city, a work order put on the building. Scared most buyers off. And I made offers on this building, but I didn't get it. It just went outside my price range there. But that was a building, and I know the guy that ended up buying it. He bought it for 1.15 million. He put in like 3.5 million. And I believe, he hasn't got the final appraisal yet, but he's sorry, not 3.5, Rav, 350,000. Sorry, I misspoke there. So he's in for like 1.6 million.
Okay.
And I think conservatively, he's going to get a value somewhere around 1.8 million. And there's another example of doing it on scale. And although he might not pull all his money out in that scenario, he's got an opportunity to have something that's going to go up in value more over time. It's going to give him greater cash flow. So he's getting rewarded more for his time and effort now. So I look at it, if I have to put all this time and effort in for 1 unit, it's not that much more for me to put that time and effort in for 8.
Love it. Andrew, time flies when we're having fun. Thank you so much for being on the show with me and educating our viewers.
Thanks for having me, Rab.
And thank you for watching at home. Without you, we would not have a show. Make sure you tune in next week. Same place, same time. Honey, I love you. I'll be home soon. Thanks for watching, everyone.